Because bonds have been returning exactly, I think, squat from an income perspective, stocks have done probably better than they should have. Would you agree with that?
Yeah, I think when we're looking at the valuations, particularly for large caps, because let's separate it between your growth and your large caps. But what we know is that since we've been in this low interest environment, or lowering interest rate environment, it's your low volatility stocks and those stocks that deliver the highest dividend yield. So we're talking about utilities, some of your financials, more the insurance companies, some healthcare. Those are the stocks that are going to keep you going, even as we may face potential higher valuations, potentials.
Yeah, because if you're my father out there who's retired for a couple of years and you're thinking I need some income, you're looking at a 10-year, it's yielding 1.7, or you're looking at your power company, which is not going to go out of business and yielding 3%. You're going into the utility stock, but Dad, if you're watching, and I know he does, now you're talking about 22 and 24 times earnings on some of these utility stocks.
So what you're paying for is the consistency of earnings. Exactly. You're going to grow slightly ahead of most of the inflation rates, and you're going to get this 4% dividend yield. So these are low volatility. I think it's just a safer bet in general, not just talking about interest rates, but just the type of market environment we've been seeing when we have this overhead of trade wars. I think if you're in the large cap, you're already paying very high valuations. This is one area where you can actually go to sleep.
Very high or too high?
I would say very high. It's at the top of its sort of 3-year range. We're getting close to 18 times forward earnings, which is normal in an area where there really aren't other world economies to invest in and low interest rates. But it's getting high, and so it doesn't take much for it to crack and for those valuations to come down.
And your whole thesis right now, not the whole thesis, but a big part of your thesis is small caps have been largely ignored. They've been kind of put on the scrap heap, and you're going to get a lot more earnings growth for your investment dollar.
Yeah, so looking over the next year, essentially you're going to get about twice the rate of earnings growth that you are with large cap, but they're trading at about a 5 to 7% discount to your large cap. So you're getting double your earnings growth, and they're actually trading lower. And when you look at valuations of small caps to large caps, this inversion of small caps being cheaper has happened maybe once in the past 20 years. I mean, this is just a big buy signal.
Why do you think it's happened? Is it because people have just, A, ignored small caps, B, the ETF market just skews to the big side, or C, there's a lot of concerns about domestic recessions, and these companies are domestic? Or D, all the above?
I think it's more a fact that we've been pushing the large cap valuations up. There has been so much focus on your mega caps. And as of the past 2 years, you've been seeing everybody focus on your Facebooks and your and Amazons, that type of thing. And they've really just been forgotten. I think it's very much of an out of favor. And I also think on the global marketplace, since so many investors are just piling into U.S. equities, they tend to just go to the large caps. They don't disperse across a different market cap
So
sections.
In your view, at Gibbs, we should be buying, if we're going to buy stocks, buy small caps. They're a better value than big caps.
Yeah, so you might have a little more bumpiness over, let's say, the next 6 months. But for me, when coming out of 2020, that's the place to be.